Hello, welcome to Section 3, Policy Impact. In Section 1, we talked about the pandemic and megatrends that are happening over a long period of time. Second, we looked at the current economic picture and the future based on the GDP in the labor force. In this section, we are going to take a look at what is the impact of policy on the current economic and future economic conditions. We're going to look at it from the government policy perspective, and it's broken into two pieces: monetary, interest rates, money supply; fiscal, tax, and spending. The policy impact is a result of two things. First, what is the actual actions that a governing body does? What are the actions the governing body is engaging in? And the second is the result or consequence of those. They can be intended or unintended. This is not a pure mathematical exercise. And the result, the impact, is really the output, what the agency or body is doing, and then they're the results. Okay, so we do want to distinguish them as we move forward. Monetary policy is generally done by central banks. Most countries have them, and in the United States, it's the Federal Reserve Bank. And when we look at what it is Congress oversees the Federal Reserve and its entities. The president appoints members. But there's the Board of Governors, and it's an independent agency of the federal government. They do not report to the president. They then have the local Federal Reserve banks, and then they have the Open Market Committee. So the Board of Governors is what drives the monetary policy of the United States. But let's back up for a second and say what drives interest rates overall. And the more money is in demand, the higher the rate. The lower the demand, the lower the price. Basic supply and demand, as we talked up front. Then you look at risk and return profile. The longer the term of the loan or the time period that's being lent, the higher the rate, because you're taking on more risk over a period of time. The shorter the term, the lower the risk, because you have time to make it back up. Now, we also look at credit. The higher the credit, or the risk of not getting paid, the higher the rate. The better the credit, the lower the rate. Now, U.S. government securities have no principal risk, but they do have inflation risk. So if we start our discussion with monetary policy, what drives interest rates, we can then move into what is the role of the Federal Reserve, so that we can see what their actions are, their policies, and the intended and unintended consequences. The Federal Reserve has a dual mandate. They want price stability, which means that we don't have inflation nor deflation that is running too hot or too cold. Maximize unemployment. Okay, and we have tended to see that the lower the maximum employment level, and the inflation is low and expected to remain low, is when we would have growth. So this is the dual mandate that they have, and they have a number of tools that they can use. Open market operations, which means they can buy and sell treasury bonds to affect bank reserves. How much does the bank have to keep in a reserve? The major form of monetary policy is open markets. Okay, the discount window is you can lend a member bank to affect bank reserves, because banks have to keep a certain percentage of their deposits with the Fed. Okay, so they target a Fed funds rate. When you go to the discount window of the Fed, you're borrowing for the Fed overnight, short-term money, and they call it, the rate they charge is the Fed funds rate. Okay? In the past, the discount window has been the lender of last resort. Generally, banks will try to fund each other and not engage the Fed. Next thing the Fed can do is change the reserve ratio. How much do they need to actually keep on deposit? So those are the three tools: open market, discount window, and reserve ratio. Those are the tools they have to implement monetary policy. When we look at interest rates today, and this is May 15th, Friday, and what you can see is that interest rates are incredibly low. So the yield on a 30-year bond is 1.269%. This is not set by the Federal Reserve. This is the markets setting this. The rate that the Fed is really dealing with is way down here. And as you can see, for a 7-year note, 10 years is 0.6. So somebody's willing to accept a return of 0.6 for 10 years. And if we look at how this is, what's happened over the past 5 days, we were up at almost 0.72, and now we've dropped. Keep thinking the supply and demand. What we also look at is the yield curve, and what that does is it shows us what the interest rate is on the short end, meaning 1 month maturity, the long end, which is 30. And what we see here is the current at 0.63, and it's close to the 0.6. It moves so much, so quickly, that getting these all absolutely perfect is tough. But you don't really need to know that. But you can see it's almost a normal that the interest rates are lower and they rise as time goes on. This is what we would call a normal curve. If we go back to May of 2019, right here, what we had is we had short-term rates were almost higher than the longer-term rates. This we would call an inverted yield curve. If we go back to May of 2018, we had also a fairly normal curve. But if we look at what has happened in 2 years, interest rates have dropped precipitously. Okay? And some of this is that the money is there, but there's no use for it. Companies can't make investments because they're not getting a return. So that's the yield curve. Important to know what a yield curve is and what it's telling us. We then look at what's the spread between a 10-year here and a 1 year. And it is a spread. And as this shows here, is this chart goes back to 1960, and it shows us what the difference between the 10-year and 1 year is. And whenever we've had it being negative, it has predicted a recession. And here we were where it's negative again this year, so it has been predictive. Okay, so here you almost had it negative, that people were willing, the 10-year and the 1 year were essentially the same. And as of today, it's only a 48 basis points difference, which is not a lot. If we go back to right after the Great Recession, we can see that the spread was almost 3%. So that's just to give you a little sense of what's happening with rates today. Rates are very important because that's what people can borrow at, but it's also an indicator of what the supply and demand of money is. The Federal Reserve Bank is taking extraordinary actions in this time of crisis. They've done a few things. They've reduced the Fed funds target rate from 0 to 0.25. So that means that if you can't find somebody to lend to you in the overnight market, and this is for banks, that you can borrow from the Fed at a rate of between 0 and 0.25%. The other thing they've done, and they've given guidance that they intend to keep this rate low for a period of time. The markets like financial stability. The security purchases, they try to provide liquidity. This is liquidity, and they've purchased over $3.5 trillion in the past couple of months. These are U.S. Treasury bonds, notes, bills. It also includes government-guaranteed mortgages such as Ginnie Mae and Fannie Mae. This is to provide liquidity into the system. They're lending to securities dealers, very low 90-day loans to the primary dealers. Primary dealers are those that sell the securities of the United States. The Treasury does not, for the most part, sell them directly. Most of them are bought and sold through primary dealers. They're backstopping money market mutual funds to keep them at $1. The repo market is over $1 trillion overnight. Again, to keep liquidity, keep money flowing. They're doing direct lending to banks. In the past, if you had to go to the Fed window to borrow, oh, that was bad. Today, it's not so bad. They're encouraging it. They've set up international swap lines with other banks so that we can continue to keep trade going and access to U.S. dollars. They've eased some of the regulations. So these things are tools that the Fed is using. It's keeping liquidity or cash moving so that we don't seize up. It doesn't help with solvency. Okay? Very important to understand the difference of liquidity, which is keeping cash available, versus solvency of a company. They're two very, very different things. They're also engaging in things that they've never done before. And to me, this is rather scary, but I think it's indicative of what's going on. They are becoming a direct lending to major corporate employers by buying corporate bonds. In the past, they were all government or government guaranteed securities. So they've taken on a little more risk. Direct lending to states and municipalities, buying bonds secured by auto loans and credit cards to keep that market going. Because if a bank or lender wants to issue credit auto loans to consumers, they need the funds to do that. Okay? So what a bank or lender would do is take a pile of auto loans, package them up, and could sell them now to the Federal Reserve, who would keep them on their balance sheet, thus providing more cash for that lender to make more auto loans. Okay?